Hello, everyone. Thank you for joining in on our first session. So, I will in this today's session we'll be looking at overview of tax in Australia, and then the other sessions will be specifically on Q&As on uh, related to the course that we have been provided. So, we'll start with personal income tax return on tomorrow, and Monday we'll be talking about business tax returns. And if we talk about our resource person, Daniel Vander Heyden, so Daniel is a chartered accountant from Chartered Accountant Institute in Australia and New Zealand, and he's been doing this for 17 years. And so he's a practitioner as well as a trainer. So he's been training quite a lot of folks in his team, and now he wants to train other, right, to extend his expertise, not just in his own team but also outside, and help accountants be better at accounting, right? So tax issues and everything. And so when we got connected, I asked Daniel if he could help us with this thing, and he was quite forthcoming. And I've not seen anyone so down to earth than Daniel. So and Daniel, thank you very much for giving us this opportunity to learn from you, and we are hoping that we'll learn even more in coming days. But I think now you can take over, and the session, you can start the session and tell us how it's going to be, if there is any, will be any Q&A, or will you keep this Q&A for later sessions?
Awesome. Thanks, Shashil. It's a pleasure to have you guys all here. And definitely, I love the training aspect a lot more nowadays. So that's why I'm doing what I do. So thanks for the opportunity. Cool. So as Shashil said, today is an overview of tax in Australia. So there is a lot to cover. And this is only scratching the surface. And we'll look a little bit more as to why, I guess, throughout this session. Just the outline. So I'm going to do an overview of tax in Australia. So we'll just briefly go through what's going on. We'll look at the main types of structures. So we're looking at the main structures, not the detail, because there's, I guess, differences within each structure. We'll look at the main structures. We'll look at the types of taxes. We'll look at the key legislation, which there is a lot of, key dates and other considerations. And yes, there is a Q&A. So a bit of housekeeping. This is the first time I've used the webinar feature for Google Meets. So I think you can ask questions. So down the bottom somewhere, I don't know if someone wants to test it. There is the chat function. There's also a Q&A function. Cool. Shashil raised his hand. Do you have a question, or are you just testing it out?
Just testing it out. So there's a raise hand button, and if you want any questions to ask, then you can raise your hand. And so can people ask questions during the session, or would you like to keep it at the end of the session?
No, you can. I mean, you can ask questions through the Q&A feature. So I can see Philip's just tested it. Philip, do you want to let us know how you did the Q&A?
Yes, so if you want to go to the bottom right-hand corner, there should be a triangle, square, and circle. If you click that, it should come up as activities. And then at the bottom of Google, it should be Q&A. So you have the option to click that. Once you click it, it allows you to input a question that you'd like. So let's say anything tax related or whatnot. So put anything in there. So you guys can all drop a question in there. So try it out. And then Daniel can approve it or delete the questions.
So Shashil, if you can keep an eye on that throughout the session, that'd be awesome. So we'll try and keep most questions to the end, unless it's something urgent. Shashil, if you can just raise the question with me. Cool. Before we jump into, I do talk fast when I get excited. So if anyone finds I'm talking too fast, please let me know and I'll slow it down. And also, we're recording this session, so I think we'll share this after the session, so you've got access to it. Cool. All right, Let's get started. So, overview of tax in Australia. So I thought I'd cover why we have tax. It's probably the same in most countries, but maybe it's a bit different here. And then the levels of the the level of the government, and then the kind of key authorities. So why do we have tax? It's probably, like I say, probably the same in most countries, but it's basically to fund public services. So in Australia, health is free to a degree, education, infrastructure, all those kinds of things. So that's why we are taxed, so we can fund those public services. So there is, broadly 3 levels of government in Australia. So we've got the federal government, which governs the whole of Australia. Then we've got all the states, various state governments. I can't remember how many states there are. Anyway, there's a few. And then we've also got local governments. So, each state's broken up into local government areas. So we've got those 3 levels. And we do effectively get taxed at all 3 levels. But most of the tax we touch on, most of the taxes that we do are federal, okay? So there are some state taxes that we have to do sometimes. And we'll look at those throughout the session, but most of what we do tax. So I guess the key authorities, so we do have the federal government, like I say, does most of the taxes. Each government has their own, I guess, they make the rules for the taxes they control. But the main one for us is the federal government. So currently it's the Labor government. They basically make the rules. So they pass the laws through Parliament, which then the ATO, the Australian Tax Office, they're the ones who, I guess, implement and monitor taxes, most of the taxes in Australia. And then for each of the states, they have their own revenue officers. They're all got different names, but they're all effectively revenue officers, and they deal with all the state taxes. And then the local government just, the local councils just deal with it in-house. Okay, so that's broadly how everything in Australia works. So let's look at the types of structures. So I know each country is different in terms of the way they tax different types of structures. Australia is a bit different. So there are 5 main types of structures in Australia. So we've got individuals. So that's a person that earns a salary or wage, but it could also be we call them sole traders. You might call them sole proprietors. They're one type of entity, so they're not separate entities in Australia, at least. Then we've got partnerships. So that's either partnerships between individuals, companies, trusts, whatever it is. Okay. Probably a side note to that, there's also one called joint ventures. Not really a structure, that's more of an agreement. We've got companies. So broadly speaking, we've got a company. Within that, there's different types of companies. So you can have a limited company, which is a public company, and private company, PTY limited. We've got companies limited by guarantee and all these other kind of companies within that. Next one's trusts. I don't know if you have trusts in Nepal. It's not really a structure. It's not a separate legal entity like companies or individuals or even super funds. Again, it's an agreement, much like a partnership. And then the last one there, you do have trusts. Okay, cool. Thanks for that. And then lastly, we've got super funds here, superannuation funds. I've also got SMSFs. There's a slight difference between the types of superannuation funds, but yeah, they're essentially the same kind of company or structure. And broadly speaking, it is a trust, but the way we deal with it for tax is different. Okay, so those are the main types of structures that we have in Australia. Okay, so the types of taxes. So again, like I said, there's a lot of different types of taxes and a lot of things to cover. So you can't cover everything today. This is a broad overview of taxes in Australia. Within that, there's so much to understand, and no one ever knows. Again, I don't want to like in Nepal or other countries, but no one ever knows everything about tax. The big thing you need to know is there's a problem, and I know how to go and research it and figure out or come up with a solution. Okay, so I'm going to touch on the broad taxes, the main taxes we see in Australia. But like I said, there's a lot of things to understand, within that too. So yeah, those are the main types of taxes. We'll jump at each one. But yeah, we've got income tax. which is broadly a tax on profits. Goods and services tax, it's a value-added tax. I assume you've got those over there too. Capital gains tax, it's an interesting one. We'll dig into that. FBT, again, don't know if you got that. We'll dig into that. And then we'll take a quick look at state and local taxes. Okay, so first up, income tax. So income tax, like I said, is a tax on profits. Okay, so if you want to dig in a little bit on what the profit is, it's not necessarily what's on the P&L. There are tax adjustments, and we don't have time to go through this today. We might, touch on it on Monday, maybe in further sessions. But there are adjustments to your net profit to come up with your taxable. We call it the taxable income. Okay, so there are tax adjustments and things like that. So it could be like tax depreciation, right? Which could be different to your accounting depreciation, or things like super. When super is not paid, it's not deductible. So there's a whole lot of adjustments that go in to make up the tax, the taxable income, which tax is paid on. So income tax does apply to most structures, and we'll look at those in a second. And the rate depends on that type of structure. Okay, so there's different rates. So if we look at individuals, so this is a salary or wage earner, or like I say, a sole trader or sole proprietor, whatever you like to call it. Okay, so they're taxed at marginal rates, right? So depending on how much money you earn, a certain rate applies. Okay, so you can see in the table below there, so you can see the first 18,200 is tax free. Then everything between 18,200 and 45,000 is taxed at 16%, and so on. So the marginal rate means basically each rate applies, right? So if you're earning over 190, you don't go straight to 45 cents. You get to claim all the the various different marginal rates up to that, and then everything above them 190,000 is taxed at 45%. So yeah, it's again, I don't know how it works overseas. But yeah, in Australia, at least, you get to claim all the various, I guess, marginal rates. Yeah, so Philip made a good point. So it does change year on year. So this is the 2025 tax rates. So we just had a few changes. So the tax rates changed slightly. The main change they made for 2025, which is the current financial year, they've changed the thresholds, I guess. So the top threshold was $180,000 up until last financial year, and now it's 190. Actually, I just realized I forgot to put in the financial year end dates in this in this session. So just to does anyone know what the year end date in Australia is? Yeah, okay. So the financial year in Australia runs from, yeah, that's right, June. So it runs from the 1st of July to the 30th of June, okay? And so on the 1st of July 2024, we started what we call the 2025 financial year, because it ends on 30 June 2025. So when someone says 2025 financial year, they're referring to anything from 1st of July 2024. Now, there are some exceptions. You can change your financial year end date, but there's a whole process to that, and we won't. It's too much to cover in this session. Most people, the financial year end is 30 June. Cool. So yes, great question there. So the Medicare levy. So in addition to those percentages, so you got your top marginal rate of 45 cents. That doesn't include Medicare levy. So Medicare is 2% of your earnings. Okay. So Medicare is basically healthcare. So that's added on top. So in effect, the top marginal rate in Australia is 47 cents, including the Medicare, and it doesn't change very often. So I'm trying to remember the last time it changed. It used to be 1%, and then it slowly went up to 2%. I reckon it's probably a decade ago since they've increased it. Can't remember exactly, but it doesn't change as often as the tax rate changes. Cool. Next, companies. So companies are much simpler than individuals. We don't have marginal rates. We've got two tax rates in Australia. So basically, we've got what we call a base rate entity. So that's a small business. They get taxed 25% of profits or of taxable income. Okay. Larger companies are charged 30%. So anything with 50 million or more revenue. Also, did say there with companies that have predominantly passive income are taxed at 30%. So this scenario, you probably won't see a lot until you get into doing a lot more trusts. So often in Australia, when you have a trust, one of your beneficiaries will be a company, and all that does is retain profits, right? And it might invest money into, I don't know, shares or crypto or property or whatever it is, right? And so income from those types of investments are called passive, because it basically just makes money for investing in it, right? And so those types of companies are charged 30% tax rates. Excuse me. So most of the companies, though, you will see are charged 25% tax. Okay, so again, that's on their taxable income, which has those tax adjustments. I forgot to mention with the individuals, and same with companies, we just got income tax returns. Okay, so we've got the individual tax return and the company tax return, so they're separate forms. Okay, partnerships. So partnerships, they're not actually taxed, right? You'll see it's very similar to trusts. So partnerships are it's an agreement. It's not a separate structure per se. And so what happens is the profits of the partnership are distributed to the partners, and then they pay tax in their own tax returns. So it goes back into their individual tax return, and they pay it at their marginal rate. There's no different tax rate or anything like that. Just gets added to whatever income other income they have, and then based on their marginal rate, they pay tax at that rate. Okay. So yeah, it's kind of similar to a process to a company tax return, but you just have to ensure that you distribute the profits. You can't retain profits in a partnership. So you can keep the cash in the bank, but in terms of the profits, you have to allocate any profits to the partners. So yeah, partnerships, to be honest, aren't as common in Australia nowadays. Because they changed the rules quite a few years ago, so companies are a lot more common. So partnerships often happened in professional services, accountants, lawyers, etc. But they changed the rules, so companies can now, they can run those practices through companies. So partnerships aren't as common. Yeah, correct. So if we go back to individuals, sorry, the question was, so the profit is added to the individual tax return. That is correct. So with the individual taxes, the individual tax returns, it's the types of earnings that you have to declare: salaries and wages, things like trust distributions, partnership distributions, dividends paid from either companies you own, or could be shares in publicly listed companies, or dividend from those shares. Foreign income, rental income, there's a whole lot of it. Basically, if you're an Australian resident, any kind of income that you receive from around the world gets included into your individual return. And we don't differentiate, right? So I know in some countries, dividends are only taxed at a flat rate, 10% or whatever it is. In Australia, everything comes into your taxable income. Okay, so it forms part of your taxable income, everything, like all those things we just talked about. And then you pay tax on that. Crypto, correct? Crypto as well. So especially things like staking, when you stake crypto and you effectively earn interest, that comes into your tax return. As well as capital gains. We'll touch on that later, but capital gains all become part of your tax return as well. Any other questions there? Okay, cool. So partnerships, yeah, we do have to lodge a partnership. They call it a tax return, but it's basically just informing the ATO what the income, expenses, profit is, and then you have to recognize that income in the partner's tax returns. Does every individual need to file a tax return? Yes, correct. So every type of structure, individuals, partner, everyone has to file a tax return every year. That's as long as they've got a tax file number. Okay, trusts. So should I skip everyone? No, trust. Very similar to partnerships. They're not taxed because they're not actually a separate legal entity. It's an agreement. Okay. So with a partnership, you have a partnership agreement that determines how everything is run and how profits are distributed and whatnot. With trusts, you have the trust deed, and that does the same kind of thing. Excuse me. So with trusts, you have the trust deed that talks about how everything, how the assets are managed and what happens with profits and what happens with the capital gains and all that kind of stuff, right? And so, again, the trust isn't a separate legal entity, so it doesn't pay tax. That's not entirely true, but we won't get into that complexity in this session. But effectively, any profits distributed to the beneficiaries, okay? So the beneficiaries are in the trust deed, and then they pay tax at their marginal rates, much like much like partners, sorry. It goes that whatever the profit is goes into the individual tax returns, and then they pay tax on their marginal rate. So question is, so for partnerships and trusts, sorry, I just lost that. Give me a sec. Where is that gone? So for partnerships and trust tax returns, the entity files one return and the beneficiary files their own. Correct. So for both trusts and partnerships, they have to do their tax returns. They're not really tax returns, but they call them tax returns. They have to file those at least at the same time as you do the individual. But yeah, and then we have to recognize, depending on the splits, we recognize the income in each either beneficiaries or in each partner's individual tax return. Excuse me. So we do use software, which hopefully most of you have looked through the training. So Zero Tax, for example, it does automate that, right? So if you have a trust tax return and you have the beneficiary set up and they're all linked correctly in Zero Tax, then it automatically populates individual tax returns, okay? So we've got software that automates a lot of it now. And we still need to do the calculations, but in terms of actually creating the tax returns, it's a lot more automated, okay? And so with trusts, like partnerships, everything's is in the trust deed, okay? So everything you need to know is in the trust deed. It's like I said, it's more of an agreement. So it's basically an agreement between a settler, a settler, a trustee, and the beneficiaries, basically. Not even the beneficiaries, they just benefit from it. Okay, and the last one, there is super funds. So I got super fund / SMSF. So does anyone know the difference between a regulated fund and a self-managed fund? Okay, so in Australia, we effectively have two types of super funds, right? So we've got regulated, so that's when a bank or an industry fund, we call it, looks after your super. So you pay the money to them and they look after it for you until you retire, okay? So that's the whole point of the super, is to save money for when you retire. Excuse me. So you've got the regulated fund, and the other alternative is what we call self-managed super fund, which pretty much speaks for itself. So you manage your own super, okay? It's a separate legal entity, right? And there's a lot of rules around it to stop people trying to take money out of it when you're not allowed to. You're not allowed to take it out until you reach retirement age, basically. But yeah, you've got the choice of managing your own, okay? So the big super funds we wouldn't touch, okay? They have their own in-house teams and they use the big accounting firms. But self-managed super funds are quite common in Australia, especially for high net worth individuals. Okay, so they want to manage their own super. Excuse me. The reason they want to do that is predominantly because they want to invest in things they want to invest in. So a lot of people buy property through their self-managed super funds. That could be residential property, right? Or if they have their own business, they might buy the office building that they're in. So they'll buy their office building, rent it back to their company, and they can do that and build their own super fund while paying their own mortgage, basically. So there are some advantages to it. So I did touch on before that a super fund is actually a trust. So I'm saying trusts don't get taxed, except super funds, they do get taxed. They get taxed in their own name, in their own right. Okay, so it's a little bit different to, I guess, a standard trust. But yeah, so they are taxed, and it's taxed at a flat rate of 15%. So that's on all profits. Yeah. There are changes coming, so they are proposing an additional 15% for super funds with large balances. So basically, the people with a lot of super will be taxed at 30%. Now, there's a lot of uproar about this, so it'd be interesting to see what happens. But yeah, it's potentially going to happen for people with large super balances. And then there is, yeah, the lodgement is a self-managed super fund return. So like I said, there is a super fund, especially SMSFs, that we deal with. It'll be the same requirements for normal super funds, but they have a lot of rules to adhere to. So it has to be audited. It's quite stringent in the way you look after the books. Typically, you can't use things like Xero or QuickBooks or MYOB. You use specialized software for self-managed super funds. So like internally, we use BGL. But there's quite a few others out there, and they're quite stringent in the way everything is handled. Just checking for time. We're going well. Cool. All right. So those are income taxes, right? So, like I say, those are taxed on profits of the various structures, right? The next one is goods and services tax. So it's a value-added tax. We call it GST in Australia, same as New Zealand. And it's just effectively a tax on most goods and services. Okay, so it's added like a value-added tax on top of the price of the goods or service. So in Australia, again, flat rate. Again, I don't know how it works in Nepal. I know other countries have rates depending on the various kinds of goods and services. But in Australia, it's flat 10% on most, but not all goods and services. So there are a few exemptions, which can get tricky. Here it's flat 13%. That would be a hard one to calculate. In New Zealand, it's 15%. So we go up by started off at 10. So it goes up by 2.5% increments. So yeah. Yeah, so to get GST through Parliament, basically, the Liberal government at the time had to negotiate with Labor, and Labor's basically said, we will let it through, but there are some exemptions we want to see. And so we've got two types of exemptions. So we've got GST exempt suppliers, and we've got input taxed suppliers. Okay, so the main differences between the two. So they're with both types of exemptions, no GST is paid on top of the goods or service. Okay, but where it differs is claiming any GST tax credits, right? So think things like commercial rent. Okay, when you have commercial rent, you pay GST. When you have, I don't know, your accountant's fees, right? They have GST on it. And so when it's GST exempt, so things like healthcare, education, fresh food, imports, exports, they're GST exempt. So you get to claim back the tax credits for any of your expenses. Okay. So for example, the commercial rent. With input tax though, with input tax services or suppliers, you don't get to claim that back. So if you have a residential property, for example, and you rent it out, any expenses that you incur, so such as repairs, right? Maybe you got an electrician there. You can't claim back the GST for that. Okay, so that's the main difference. Financial services, you probably won't deal with a lot of those companies. I've dealt with very few, but yeah, it's mainly residential houses, but they're quite often owned by individuals anyway. So I should probably talk about the purpose of GST. So GST, even though it's a federal tax, it's actually distributed to the various states. So it used to be all these various sales taxes throughout all the states in Australia, and so they've effectively streamlined it and created GST, and then it gets distributed between the various states. So there is a few different lodgements. Broadly, they're called activity statements. Excuse me. But they're broken down into, depending on when you lodge them, so either a BAS, an IAS, a GST return, or a PAYG installment. Okay. Actually, there's a bit of a mistake. IAS and PAYG installments are slightly different. They're activity statements, but they don't report GST. The main one which we'll look at is BAS and GST return. Is there any thresholds for GST? Yes, there is a threshold for GST. So the threshold in Australia is $75,000. Okay. And so it's not like the marginal rates where it steps up. It's basically when you think you're going to make $75,000 in a financial year, you register. Okay. So yeah, it doesn't step up. So it's not like you get to 75,000 then register. You got to estimate when you think you're going to get there. So there are some exceptions, or one main exception. If you're a taxi driver, there are some, I think it's mainly taxi drivers, they have to be registered, right? So they've got no choice. Or if you're not for profit, the threshold's double, so it's $150,000. But yeah, once you're registered, you have to charge GST to your clients. And so typically the way I do it is if you've got a client that works predominantly with businesses, so B2B, I always recommend they register for GST because it's one, it's simple. Two, they get to charge it on top of the normal fee. And three, they get to claim back the expenses. Excuse me. Any other questions on that? Cool. All right, FBT. This one I hate. I hate FBT. It's the worst tax. It's not fun to work out. People don't like it, but we have to do it. So again, I don't know if you have FBT over there, fringe benefits tax, but it's basically a way to tax non-cash benefits, right? So back in the day, rather than pay bonuses or given a pay rise, they would pay for people's houses, right? Because it wasn't taxed. And so you get a car, you get a house, they pay for your holidays, like all that kind of stuff. And the government's like, hang on, we want some tax. So basically, because FBT isn't part of the normal, I guess, income tax side of things, they've had to create a new kind of tax we call fringe benefits tax. And so, like I said, it applies to most benefits outside of salaries and wages. And I've just put in there otherwise deductible and minor benefit. So again, we won't dive into detail here. If you want another session on FBT, that's a whole thing in itself. But there are some ways around it. So we've got otherwise deductible. So, you know, if you provide, say, a laptop to your employees and it's for business, you know, you get to claim the deduction because it would have been deductible if you bought it yourself. And minor benefit, so this comes up a lot at this time of year, Christmas time. So entertainment is one of the biggest expenses. So Christmas parties, basically you've got a minor benefit if it's less than $300. We add all, okay, cool, gotcha. Yeah, so to work out the fringe benefits tax, it's a bit of a funny one. We call these things in Australia taxes, but they kind of just fall into line with your income tax. And so basically, you've got to gross up your benefits. You got to work out what your benefit is. Okay, so if it's a car, for example, you got to work out all the values of the cars. If it's entertainment, you got to work out you got to work out what the benefit is, and then you've got to work out how to apportion it as well. So there's a whole lot of things you need to do. But then once you've worked out what the benefit is, you need to determine if it's type 1 or type 2. Okay, type 1 is those. It relates to GST, right? So type 1, any benefits that are GSTable, so they have GST in the price. Gross up 2 is when there is no GST. So type 1 is most benefits. Type 2 would be things like, I don't know, rents or financial services, any of those exempt kind of GST items. I probably didn't range this very well. Let's get to, so let's just go through it. So not-for-profits, they do get exemptions, either 17 grand or 30 grand of fringe benefits before they have to pay anything. So that could be anything to do with medical, like hospitals, ambulance drivers, benevolent societies, things like that, they get exemptions. Okay, and you can reduce the fringe benefits tax if the employee makes a personal contribution. Again, if you want a session on FBT, we can go through that in more detail. But yeah, there's things you can do to reduce the tax. Okay, but basically, once you work out what the benefit is and gross it up, you basically pay tax at the top marginal rate plus Medicare. So it's 47%. So, and that's borne by the company. Okay, so it's quite expensive. So if you look at the example there, I've got a motor vehicle. So you got to work out the benefit. So let's just assume it's $12,000, which is the car. So the depreciation, fuel, tires, repairs, interest, all that kind of stuff, right? Let's assume that the benefit for the employee each year is $12,000. Okay, so we need to gross it up. So take the 12,000 because let's just assume all of it's GSTable. Things like registration and stuff isn't, but let's just assume the whole lot is. So we're effectively doubling the benefit. So it's 24, or more than double there, right? So it's tad under $25,000 total, grossed up. And then FBT is at 47%. So that's tad under $12,000. So yeah, you're effectively paying the same amount as the benefit again in tax. So it gets very expensive. And so we do have to lodge a FBT return there. Okay. And yeah, if we do have, I think it's more than 4,000 a year, 2,000, I can't remember the exact threshold, you do have to pay installments in with your BAS. Okay, so I realize we're a little bit, probably a bit behind time. We've got I want to have about 15 minutes for Q&A, so I'll just quickly go through the rest. So state taxes, okay, we don't deal with these as much. Most of them revolve around stamp duties, so we don't generally calculate those. Land tax, we might have to be involved in, and payroll tax, we definitely get involved in, okay? So payroll tax is in addition to tax withheld from salaries and wages. It's a tax on top of the whole lot, which is levied at the state level. So, and there's other taxes that they do. Again, we don't deal with local governments, so they often have their own taxes. The big thing they have is council rates, but then parking, fines, all that kind of stuff is all theirs. So the key legislation. So we have two main acts, right? So the Income Tax Assessment Acts, 1936 and 1997, okay? Have a look at those. They're massive. Basically, back in 1997, they tried to rewrite the legislation and they gave up halfway through because it was too hard. And so now what it's left us with is two pieces of legislation, okay? Which is an absolute pain. Did I touch on capital gains? I think I missed capital gains. Whoops. So yeah, anyway, we'll come back to that. But yeah, so most things with income tax, capital gains tax, whatnot, is in the Income Tax Assessment Acts, okay? Including all the various structures. We don't have separate legislation for the different types of structures. Then we've got the GST Act, 1999. So that's when, basically from the year 2000, we had GST, FBT Act, Tax Administration Act, which basically governs how tax laws are applied in Australia. The one that's important for people like myself who are tax agents, we got the Tax Agent Services Act. So basically gives us our license and tells us how to, how we should act, I guess, ethically and all that kind of stuff. Corporations Act is not really a tax act. It governs companies in Australia, so director responsibilities, things like that. But the big thing for the tax side of things is it determines or tells you how to make a dividend payment, basically. Okay, so even though dividends, there is a tax component to it, the Corporations Act tells you about how dividends are, I guess, declared and distributed and things like that. And then the last two there are trust deed and company constitution / shareholders agreement. So now with those two, they're not actually legislation, they're agreements, the contracts basically. And so they do govern how trusts are run for the trust deed and companies. Okay. Excuse me. So a lot, obviously you've got all these Income Tax Assessment Act or whatnot, but ultimately how things are, say, distributed or recognized, basically, let's say with like trust deeds, how income's recognized, for example, that's all governed by the trust deed or the company constitution shareholders agreement. So outside of the legislation, you also need to consider those things. And like that, partnerships aren't as common, partnership agreements too. Okay, so those, again, not legislation, but they do govern how we do our job. Key dates. So income tax. So there's a couple of different dates. So the main two we use for income tax is 31 October. Okay. So that's either self-lodgement or a person or an entity with a late lodgement needs to lodge everything by 31st of October. But most people we work with lodge their latest due date is the 15th of May. So for example, the 2024 financial year, which ended on 30 June 2024, we don't have to lodge most returns until the 15th of May 2025. So we get almost a year to lodge everything. So for GST, activity statements, whatnot, we've got three main dates. So the 21st. So 21st is for self-lodgers or monthly lodgements. Basically, if you have a, say, September BAS and you self-lodge, or it's a monthly BAS, you need to lodge it by the 21st of October. Okay. If you're doing it through a BAS or tax agent like ourselves, that same September, if it's quarterly, doesn't count for monthly. If it's a quarterly September BAS, then it's not due to the 25th of November. So you get almost 2 months to lodge it. And if you've got annual GST returns, so you only do it annually, it's due at the same time as your tax return. So it's typically 15th of May. FBT, 1st of May if you're self-lodge, or 25th of June. Excuse me. But they do have a different year-end date. So the year-end date for FBT is 31st of March. And then state and local governments, it varies, depends on many factors. Other considerations. So there are certain benefits and they often change. So things like tax offsets. We did have a low and middle income tax offset of, I think it was $1,500 for individuals up until 2023 financial year, and that stopped, which upset a lot of people. But we often get these offsets to reduce our tax. There's also a lot of other benefits. Depreciation is a big one. So up until, again, 2023, if you bought an asset that was up to $150,000 in value, you got to write the whole thing off. Now that threshold come back down, it's still $20,000, but otherwise you have to depreciate it over time. R&D is another big one in Australia. So research and development grants or research development tax offset. So you effectively get back, I think it's about 43.5%. I think it is, off the top of my head, of any research and development expenses. So if you spend 100 grand, you effectively get 43,500 back. And there's a whole lot of other benefits, depending on industries and stuff like that. Then we've got government grants. Again, those change every year. There are some that are recurring, like EMDG, so Export Marketing Development Grant. But a lot of them change year by year. It depends on what the plans are for the government. So there's a lot around energy and things like that at the moment. And then tax planning. So as you can see, tax in Australia is very complicated. There's a lot to consider. And so tax planning is very important. So I'll just put a few things down there. So negative gearing. We'll come back to your question in a sec. So negative gearing is big. So people buy properties, they make a loss on that, they get to claim a tax deduction, or they get to claim the losses in their taxes. Super, you can claim up to $30,000 a year in super. So people often top up the super to get a bigger tax deduction, maybe get a refund. Australia with dividends, we've got franking credits. Don't know if you have them overseas. Again, we can go into detail another time. But effectively, any tax the company pays, you get an offset yourself. And then trust distributions. There's a lot we can do around that. So those are the main things. I didn't forget to touch on capital gains tax. So just briefly on capital gains tax, it isn't a separate tax in Australia. Okay, so capital gains tax is, you have an asset, you have a house, for example, right, and you sell it. You've got to pay tax on it, and so basically we call that a statutory I guess, income because it's not part of the normal legislation. It's a separate. It's a new section within the. I think it's Income Tax Assessment Act 19. I forget which one actually. 1997, I think, where they bring in capital gains into your normal taxable income. Okay, so if you're an individual, you get taxed on whatever the gain is. So the sale price of the asset less the cost, and you get the profit. Okay, if you hold that asset for longer than 12 months, you get a 50% discount, and then you pay tax on that. So if you have a property for say $1.5 million sale price, you just bought it for $500,000, so your profit is $1 million. Sorry, and then you get the 50% discount. So that means you pay tax on only 500,000, not the whole million. And then that gets paid at your marginal rate. Okay, cool. So I know there was a lot to digest there, and we flew through it in 45 minutes. Again, there's a lot more we can dig into. There's a lot to consider in Australia for tax, at least. Assume it's similar overseas. But yeah, hopefully that gives you a good overview. So yeah, capital gains. No, there is no separate tax rate. Basically, you need to work out what the capital gain is, less any discounts if you're entitled to them. Okay, and then whatever that net capital gain is, it gets put into your normal taxable income. Okay, the individual, you use your marginal rates. Why is FBT so high? I don't know. I think they're just trying to stop it. But also remember with FBT, excuse me, you get to claim deductions for all the expenses. Okay, so you get to claim the deduction for the benefits itself, and the FBT itself. You also get to claim back the GST credit. So it's probably half of that. So like I said, it doubles. It's probably how you double it up. It's probably only a quarter of that. So that example, rather be 12,000, is probably about $6,000 in actual cost. Cool. So Q&A. Sushil, did you want to jump back on and let us know if you got any questions?
Yeah, so if anyone has any questions, then please go ahead. You can put in the chat, or if you want to just speak it out, you can do that. But before that, I have some questions where you said 2 income tax assessments. I hope those provisions do not conflict with each other. And yeah,
No,
and
they
also,
don't. Sorry.
yeah, and also could you expand or tell us more about BAS, IS, and PG for others who don't actually know what it is?
Okay, cool. So the first one, yeah. So the 2 income tax assessment acts, no, they don't conflict. It's just, yeah, we've got 2 pieces of legislation to look at. so you got to know which one to look at, basically. And I still forget. So luckily we have Google or ChatGPT now, right? So to do our research. But yeah, it's different things in different acts. And they're all got different numbering and all that stuff, so it makes it fun. So hopefully they rewrite it again sometime. But it's been almost 30 years, so yeah, I don't like the chances. In terms of, so you're asking what the difference between BAS, IAS, all that stuff. Oh, you're on mute. Still there, Shazir?
Yes, BAS, IS, and PG.
Okay. So yeah, maybe I can do a session on this on Monday or something. But so basically, some taxes we pay as we go, right? So GST, we typically, okay, I'm going to say typically, there's lots of different scenarios, right? And it depends on each company, but typically GST is paid quarterly by most small business, okay? PAYG withholding, so that's tax withheld from salaries. We pay at the same time as the GST. So PAYG installments. So if we've got if we've had a taxable, if the company or a business has tax payable in the previous year, often we have to pay installments every quarter as well. So we do it at the same time as GST. Okay, so we've kind of got, and then FBT as well potentially. So you got those, I guess, different kinds of taxes. So GST, we touched on. Income, PAYG withholding is tax withheld from salaries. So you pay your employees. That tax you withhold needs to be lodged. To make it confusing, they call prepayment of income tax PAYG installments. So PAYGI. Okay, so that we don't have to calculate that. That's typically given to us by the ATO, either a fixed rate, or we can ask for a percentage, which is percentage of revenue, and then FBT similar, that's given to us. Okay, so those are all typically lodged on your what we call a business activity statement. Okay, and so that's often done quarterly, but there are different scenarios. So and it gets confusing. It's one of those things when you do more that you get used to. Like I remember when I first started doing it, I did not know the difference between everything. It took me quite a few years to understand how it all worked. But effectively, if you're paying $25,000 or more in PAYG withholding, you've got to lodge what's called an install activity statement, IAS. Okay, so that's paid monthly on the months that you don't lodge a BAS if you're lodging quarterly GST. Okay, so that's all that is payroll information and the tax withheld from salaries. Separately, you might have an individual, for example, that doesn't carry out a business. Maybe they just have a whole lot of investments, right? And so they pay more tax in addition to their salary, for example. And so they'll often pay PAYG installments, right, on a quarterly basis. So in that case, they get what's called a PAYG installment, which is another type of activity statement effectively, and they pay that to the ATO on a quarterly basis. Okay, so yeah, there's many ways of cutting up all the activity statements and all these kind of prepayments of tax.
Sure. I see two questions in the chat. Sandesh is asking what is franking credit, and Navraz is asking, do we see a residential status in income tax or not?
Okay, so franking credits, it's a whole nother topic, but let's just briefly touch on it. So in Australia, at least, I know other countries you get like on a dividend, they usually have a flat rate of tax. I think America's like 10% or something like that, right? In Australia, we don't have that. So basically, we recognize the dividend. So if we say receive, I don't know, $750 dividend, okay? Typically, the company has already paid tax at 25%, right? So that tax we get to claim back, but we recognize the whole amount. So the $750 dividend plus the $250 in franking credit is revenue for us, or income for the individual, and then you get an offset for the $250 in tax that the company's paid. And so that $250 offset is called a franking credit. So it's just an offset for the tax the company's paid.
Okay, so when you receive a dividend, you calculate the whole what you paid, what you are paid, and also what tax was paid on your dividend, and then you offset the tax.
Correct, yeah, and that's done through a dividend statement, right? Because that's a perfect scenario. Sometimes there's unfranked dividends, sometimes there's partially franked dividends, so it does get complex. But in the most simple terms, that's how it works. Yeah. And the other question, do we see residential status in income tax or not? So can you just expand on that question? I'm not too sure what has been asked there.
So I guess it is questions regarding if there is any difference in income tax as per the residential status of the person.
Gotcha. Yes. Short answer is yes. There are different rates. So the reason I kind of laugh is there's a whole lot of guidance coming around the status of people in Australia, basically, right? And so there's a couple of ways to look at it, right? So anyway, let's speak broadly, right? So broadly, yes, there is a different tax rate if you're a non-resident for tax purposes, which is different to visa and whatnot, okay? So if you're a non-resident, You only get taxed on income you earn in Australia, not on your overseas income. But you don't get the tax-free threshold. Okay, so you pay tax from the first cent you make, right, in Australia.
Right.
That's effectively the difference. There's more complexities to it, and there's questions around are they resident, are they not. There's a whole lot of guidance coming out around that at the moment.
Yeah. Okay, so if there is any more questions, this is the time to ask.
Do you have any questions, Shashil, while we're waiting for others?
I wanted to ask. So the tax forms, right? Because we were looking at the course on Zero, and it looked like all the tax forms are similar, or there's only one tax forms, but there must be tax forms for every individual. And you also touched upon people have to file tax returns, so there would be tax returns different from each other, right? So a company would file a different tax form, individual different, trust different, and partnerships also different.
Yeah, correct. So Xero makes them all look similar, but they are different. So basically, each structure type has their own tax form, basically, right? So an individual has one type of form, and the way you fill out the information, the information is obviously different. But if we look at, say, if you're with an individual, they don't have a separate tax return if they're a sole trader or a sole proprietor. It's the same tax form. It's just an extra schedule on that form, right?
Yeah.
So that schedule is, even though a business is a business, at the end of the day, you got your revenue, you got your expenses, you got your profit. The way it's displayed on an individual tax return is different to, say, a company tax return. Okay, similar information, but it's a different layout.
Yeah.
And then, in addition to that, GST. So your BAS, your activity statement, that's a different kind of form. And there's, if you ever look at the types of activity statement forms, there's so many. I don't know, like 50. I don't know how many. It's a lot, right? Yeah. So it depends on the scenario. So you could have quarterly GST, quarterly PAYG, quarterly PAYG, quarterly FBT. That'd be one type of form. I forget the numbers, the letters. And then there might be like, quarterly GST, monthly PAYG withholding, quarterly, there's so many different scenarios. So, so with activity statements, lots of different types of forms. And FBT is just one form as well. But it's a different kind of form. But yeah, they're all in Xero. There's other tax softwares too, but they obviously, they look very similar because it's the software. But yeah, they're different forms.
And I would imagine A2 has its own portal where you can, without using softwares, you can upload tax forms as well.
Not quite. So you can do activity statements directly in the ATO. So we have what we call online services. So online services for agents is what we use as accountants. You can do activity statements through there, but everything else you have to lodge through software. So all your income tax returns, FBT, they'll have to be lodged using something like Xero Tax or QuickBooks Tax, or there's many other tax softwares.
Yeah, I think we have 2 more questions that have come in.
So I can see, where is it? Let me see.
It's super tax deductible, and what is the maximum deduction that is allowed?
So super contributions, yes. So if you're an employer, right? So you employ someone, you have to pay super. So the current rate for super is 11.5%. So if you pay someone $100,000 a year, you have to pay $11,500 of super to their super fund every year. Okay, and that's paid currently on a quarterly basis. Okay, and for the company or the business paying that super, it is tax deductible. Okay, if you're an individual and you want to top it up, you can claim up to $30,000. You can make tax deductible contributions to super of up to $30,000 a year. Right. So if your employer's putting, say, 11 and a half away, you've got an extra, what's that, $18,500 you put towards your super. So you can make a personal contribution, and then that is tax deductible in your personal return, and you potentially get a refund, right? So that reduces your taxable income.
Right.
Okay, does that make sense?
So your employer may contribute more than 30,000, but you'll only get deduction of 30,000 income tax.
Yeah. So the maximum deductions, well, it gets complicated there, but if you're making maximum contributions every year, the maximum is 30,000, and you can contribute up to another $110,000 after tax. There, and into super.
Right.
And the reason I say it gets complicated is we can roll over the taxable cap, the super contribution cap, for up to 5 years. So if each year you've only contributed, say, 20, the rates have changed, but let's just say, for the next 5 years, you only contribute, say, 10,000. You've got an extra 20,000 each year, which accumulates for 5 years that you can contribute.
All right. Yes. I think we have another question, an immigrant question, perhaps. Income on holiday visa, is it taxable or not?
Income you earn in Australia? Yes. Holiday visa, sorry, holiday. So assuming you're not a backpacker, you just come here for a holiday, right?
Mm-hmm.
So if you're just coming here for a holiday and you're not earning any income, no, not at all. If you backpackers, often, they'll go work on farms or whatever for a little bit of money. That income is taxable in Australia, but nothing else. If it's just a pure holiday to, see Australia, then no, you're not taxed. Other than GST. That's another story.
Okay, so any more questions? If not, then I think we have come to the end also.
All right, awesome. Just before you jump off, if you do want to connect, feel free to reach out. I know some of you have connected with me on LinkedIn. Sorry if I haven't got around to accepting it yet. I've got quite a few there, so I'll look at that over the break. You can also follow us on LinkedIn, Facebook, Instagram, TikTok as well.
Yeah.
Thank you very much, guys, and we'll see you all tomorrow.